I typically invest very early on in a company's formation. And at that point, I would say probably the most important thing is the team, because the idea may change, the product may change, but the people hopefully won't. What I'm really looking for in founders is that the sense of urgency to build something, and can he or she adequately and eloquently tell that story to a prospective investor? Why are we called angels? It's really important that you stand behind that. You are there to help and support founders in whichever way you can, and that sometimes when things are going well, but often it's also when things are more challenging, and then it's really important to show what you can do as an angel investor.
Hello everyone, welcome back to Investor Returns. I'm Ulyana Shtybel, and in this podcast we dive deep into the world of venture capital and angel investing. Today I'm joined by Nic Lenz, a strategic advisor, mentor, and experienced angel investor. Nic has 18 years in investment banking, building and rebuilding fixed income franchises for Morgan Stanley, UBS, and Bank of America. Later, Nic left the banking and established his own consultancy in 2017, which is focused on supporting early-stage founders. And Nic is an experienced angel investor. He invested in over 20 startups, scale-ups, and had already 3 exits from his investments. And Nic recently been nominated for the Angel Investor of the Year in the UK. So Nic, welcome to Investor Returns. I'm looking forward to hear your story and actually welcome you to introduce yourself and also tell us how you got in the angel investing.
Thank you, Ulyana, and thank you very much for inviting me onto your podcast. Pleasure to be here. As you said, I guess my learning ground was very much in investment banking in terms of my professional career, but I've always been quite entrepreneurial. And even as a kid, I had different businesses that I was running, and even within investment banking, I was always involved in either building or rebuilding businesses, albeit under the auspices of a large corporate. So I changed careers in 2017, as you said, to be focused much more on early stage startups. I really was fascinated by what was happening in fintech in particular, and that's the area where I guess I have most experience and interface with as my career in finance. And that sparked my curiosity in terms of how do these business models work? How do these companies grow and scale? What are they doing different to incumbents? And so that started also both my professional consultancy, where I help founders, but also my own angel investing career.
And can you share with us what actually the findings are? What do you see the patterns of success, or maybe patterns of a failure in a startup?
Yeah, so I typically invest very early on in a company's formation, and at that point, I would say probably the most important thing is the team and the people behind the company, because the idea may change, the product may change, but the people hopefully won't. And so what I'm really looking for in founders is that the sense of urgency to build something, fix a problem that they may have encountered in their own lives. And that is, at a very early stage, probably one of the most important things to focus on. It's like, why is this person deciding to become a founder, which in my mind actually is one of the hardest things you can do in life, is to start your own business. And you will recognize this as a founder yourself. So there needs to be, for me, that real spark, that real kind of desire to change something for the better, and that's probably the most important aspect. What I look for. Then other aspects in founders in particular is a incredible drive and vision of what it is they want to build, coupled with a healthy doses of resilience, because it's not a straightforward path. So those are the types of characteristics I guess I look for in startup founders. In terms of the companies that I've supported, worked with, or invested in that haven't made it, some of the learnings there, oftentimes it's timing. So maybe some very novel solutions, but the market simply wasn't right, or the timing wasn't right for that solution to become mainstream. Sometimes the focus was perhaps too much on the product and not ultimately what are the solution that you're solving for. So that's been a real learning for me, is really going back to first principles, is what solution, what pain point are you solving for your end clients? And that's definitely a learning I try to take with me on everything that I do now going forward.
And how do you look actually on the market? For you personally, should it be a large market and the unicorn potential when you're investing in a startup, or you also investing in smaller markets solution? How do you look and how do you measure market for yourself?
Yeah, so that's a great question, and to be honest, it really depends. But the foundational principle that I work from is that the market has to be big enough for this to become a very meaningful business. Now, whether you define it as a unicorn or some other measure, but there has to be a market, an addressable market that the company is going after that is significant, meaningful, and also growing. Now, that may mean to start off with that the company focuses maybe on a specific niche, and not so much on the wider market. But then I want to understand, okay, once you've built a presence in this niche market, how do we then go to scale and to a much broader audience and marketplace?
Yeah, totally understand the approach. Kind of, if the company actually has a potential of becoming a next corporation, maybe even not just being a product to sell for very narrow feature to another competitor, right? Or to some larger corporation, but actually if potentially this company can become a next corporation, right? Because it's only if there is enough market and enough application of the technology when it could happen.
Agreed. Now, that being said, though, obviously there are circumstances where companies may be acquired before they get to a stage where you thought they would ultimately end up, and that happens too. But in terms of what do I need to believe to invest in these companies, it's definitely, is there the ambition from the founding team and the founders, and is the market sufficient size to make this a very substantial business?
And what about your exits? Actually, just to recap, how many of the exits do you have? And
that's 3 exits to date, but my portfolio is still relatively young. I've been investing, I guess, really 6-7 years now in total, in earnest.
I can say it's actually a very good result in the 7 years to have already 3 exits, at least from what I hear when interviewing angel investors. So those exits, do you have some learnings from them? Was it anything really specific about those companies that made them be successful and actually need the exit?
Yeah, so what they all share is absolutely a very, very strong founding team with complementary skill sets. So that's a absolute consistent theme through all three exits. The nature of the exits have been quite different, but the journey has been similar in the sense that, you know, they just built an awesome product where there was a real demand and a pull from the market for that product to exist. And that was evident quite early on. So yeah, the founding team was a critical part in terms of how the company grew and how it was able to execute on the journey. And the second thing was the evidence for the need for the product that they were building was evident, you know, quite early on. So then it's a case of how do we execute and scale as quickly and as fast as possible to win market share.
So in those three exits, how many founders were in each company?
So to start with, I would say two of the companies had two founders, and the third company had four founders to start with.
Yeah, interesting. Trying to find some patterns. And generally, I know that it's very difficult to be a solo founder. And there are, of course, exceptions to the rule. But I think most of the successful companies are more than two founders. And from the experience of founder myself, I can say that it's good to have more co-founders who can cover some skill set and definitely contribute to the company's success. Because in the end of the day, you as a person, you still have only 7 days per week and 24 hours. And that's it, right? And the responsibilities of building a company as a super wide.
Yeah, no, absolutely. And even more important than that, I think just having another person who shares the journey with you, who you can rely upon, you know, because it's not a straight line, right? It's you have to go through many very difficult situations before you ultimately reach the destination. And I think as a general rule, it definitely helps having more than a solo founder. I have had some companies who've been where I invested, they were solo founder, but they quickly appointed a co-founder, and they recognized that they needed additional expertise that they didn't have. But I think making it as a solo founder is very, very hard.
Have you invested in companies which already have a competition on the market, like strong competition, or it's usually this first, second, maybe third comer to the market with quite unique technology or solution?
That's a good question. The way I think about competition actually for startups is probably that's the last thing they want to think about. And I say that from the perspective that if you're going into a market which is big enough, then competition really doesn't really come into play until much, much later on in your journey. There is so much market share. And if you're building a product which is good and strong enough, then yeah, use competition as fuel. And it's not something I can understand why founders are concerned about competition. And I 100% believe that you need to build something that's truly differentiated to win. But I think that there is a tendency for founders to be slightly over obsessed about what the competition is doing. You know, at this early stage, you have so much to prove and there is so much green space for you to grow into. Focus on building an awesome product and the competition will take care of itself is kind of my mantra.
And about the fundraising journey for founders, I think you interviewed over 200 founders when you've been working as a consultant, and also helping them with the fundraising journey. So, what kind of findings you have from that experience about fundraising, but also maybe about other aspects of running the business?
Yeah, so the stage in my career when I interviewed, so to speak, the founders was when I left banking, and when I started, or before I started my own consultancy. I got introduced to a startup accelerator where I became a mentor, and that allowed me to meet all of these founders. And so over the space of a year or so, I met just over 200 of them, which was fantastic for me because I was wanting to understand what is it that you as a founder struggle with. What are some of the really key sticking points and barriers for you that prevent you from growing? And out of those conversations came, I guess, two key learnings. I met some incredible founders, and some of them I still work with today. But most of them found the funding piece, so the fundraising piece for their own business, very, very hard. It's a foreign language, particularly if you're a first-time founder. And that's something as an angel investor that I was reasonably fluent in. And I understood that market and understood what venture investors were looking for. And the second learning from all those conversations was many founders had some product, some MVP, and maybe some traction. But how do you then really think about building the foundational elements that allow you to scale that business and really, make it into a substantial operation and a meaningful business? So that scaling piece, which ultimately comes back to go-to-market. How do you think about and how do you execute on a go-to-market strategy? I guess those were the two key learnings from those conversations that I had very early on in my own, the start of my journey as an independent consultant. From a fundraising perspective, I mean, there are many learnings, but the key for me here is I want to see what the driving force is behind a founder starting the business, and can he or she adequately and eloquently tell that story to a prospective investor. Yeah, fundraising is all about storytelling, no matter what people tell you. If you can convince people by having a very compelling story to why it is you're building the products and the business that you're building, and why it is such a compelling investment proposition, then everything else takes care of itself after that. But you have to have that both drive and ability to convey that sense of passion and urgency to prospective clients, but also investors.
Yeah, definitely. And when founders approach the fundraising, so what gonna be your top 3 preparation points and techniques to get them be successful in their fundraising journey?
Great question. So the first is actually the preparation piece. Most founders that I meet underestimate how long it takes to actually be ready to go out to the market and raise equity for your business. So yeah, really doing your homework, really understanding when you are ready to engage with prospective investors. That's the key first, I guess, learning point on the fundraising journey. Secondly is it's tough. Fundraising is tough, and it requires resilience and persistence to get your your fundraising round off the ground. So be prepared for many no's before you get a yes or two. So that for me is don't underestimate how difficult it can be. Obviously on LinkedIn and various platforms, we hear about all these amazing stories about, Y Combinator founders who raise a round within 48 hours, and it's like, and they're heavily oversubscribed at a crazy valuation. But that's probably, less than 1% of the founder's journey. So I would take that with a heavy grain of salt. And then the third piece of advice is equity is the most expensive, but the only bargaining tool you have as a founder. So think really carefully both how much and to whom you want to give that equity to. So be really intentional about the investors that you want to have on your cap table, because investors actually, particularly early on, can be quite helpful in accelerating the growth of your startup. So 3 key learnings, I guess. One is prepare like really well. 2 is it's going to take time, so be resilient and never give up. And 3 is be really intentional about how you build your cap table and the investors that you end up agreeing to give a piece of your company to.
Do you believe that there are technology businesses that don't need to raise capital and can actually grow on their own revenues, or potentially actually on that money? And also, have you ever invested in any kind of venture debt opportunities?
So in terms of can a technology business build a meaningful business without external fundraising? I think it's possible, and there are some examples. I think MailChimp is probably one of those, and then there are probably a handful of others, but it's hard. So yeah, I guess the answer is, it's possible, but in today's world where actually technology is not really a key differentiator, I would argue. Technology is so accessible, and particularly with the evolution of AI, it's very rare that a technology builds a really defensible moat for a considerable time. It can give you a head start. But I do think it's very, very hard to build a lasting, large technology business without external funding. And that's simply a function of the fact that those with funding will just be able to run faster, to build quicker, and to win quicker than anyone else. So in a highly competitive environment, it's difficult, I would imagine, to build businesses that just rely on funding from the founders themselves, or maybe a very small group of angels. But they exist, but there's always an exception to the rule. I've not invested in any of those businesses. And the second part to your question, Ulyana?
It's about venture debt investments. Have you seen many companies doing it, and have you ever invested yourself in venture debt?
So the answer to the second part of that question is no, I've not invested in venture debt myself. I do have a couple of companies that I'm working with who are exploring venture debt as a way to accelerate their growth and to help them, particularly with cash flow, actually. It's not so much that they need it to, expand the business, but some companies have certain cash flow dynamics where venture debt could be a solution. but I would argue that probably only becomes feasible once you have a company that's, kind of post Series A or is doing very meaningful turnover. Venture debt is not something you want to consider very early on. You need to have relatively stable and rapidly growing cash flow and revenue generation for that to be a valid financing tool. But it can be absolutely a good way to expand the business, but much later on.
Yeah, totally. Quite understandable. In your approach to investing, do you actually diversify your portfolio? Do you invest in other asset classes?
In terms of purely in my angel portfolio, or you mean in my broader?
Your broader portfolio, because we have some angel investors or generally the investors who are listening to us, and that's the question more about how you approach your personal finance.
Right. Yeah. No, that is a good question, and actually a really important point. I think you need to, if you want to go into angel investing, and I think it's a fantastic thing if you can do it, it's a fantastic pursuit, but you have to go in with your eyes open and understand that the chances of financial success in angel investing are very, very small. So I would not let that be the primary driver of why you are angel investing. I would say let the primary driver be the journey and the learnings that you get from working with incredible founders. And then hopefully, some may stay the course and may end up being a financial success. But don't be the financial outcome, be the driver of why you start angel investing. And so with that lens, I have angel investing as being a part of my portfolio of a much broader portfolio of assets that I invest in. And it's a relatively small, although for me, because I also work, my job and my day-to-day work is in early stage tech. So probably my weighting of my angel portfolio is perhaps a little bit larger than the average angel investor. But I think if you approach the lens of, this is money that I can afford to lose, no matter what, that's probably a good starting point. And I'm doing this because I want to explore what, companies are doing and try to contribute to their success, as opposed to I'm doing this because I want to have a guaranteed financial return. That's probably, for me, the right mindset.
Yeah, Nic, you actually mentioned about co-investing with syndicates. Are you part of any syndicate group yourself, or you are leading any?
Yes, now I'm part of a syndicate in the UK called Ventures Together. And I found it incredibly helpful, actually. You get to know other angel investors, and the way that Ventures Together specifically works is that they get deals which have been backed already by a VC, and then they ask the founder. Sorry, I should perhaps just clarify. Ventures Together is predominantly angel investors who are founders themselves. So there's like 150 founder operators who are also angel investors. And so the idea is, if you're a founder looking to raise money, you can get access to all these operator founders who may be able to help you in your journey as a startup founder yourself. And so I'm a friend of Ventures Together, and they co-invest, like I said, with up to 150 different angels in the group. And that's been really useful for me. It's been a good learning, and they get also some really impressive deal flow. So that's helped on many different fronts.
Yeah, recently actually heard from one exited founder answer to the question what was the most useful in the fundraising and overall in the journey. And the founder mentioned that angel investors were. So the angel investors are great source of introductions, fundraising support, and that's especially when it exited founders who now are angels. So I can assume it's really great to be funded by them and have their support in the journey.
Yeah, and what I would say, Ulyana, that actually, as a founder, and this comes back to the aspect I touched upon earlier on in the conversation, try and be really intentional about how you build your cap table and which angel investors you want to get on board. Often founders underestimate how useful and a good cap table with investors who want to help you on your journey can be. It's often an underutilized resource by founders. So I'd really encourage founders listening to this to try and think carefully about, who they get onto their cap table, and it can really help accelerate your growth.
Yeah, exactly. And more like investment concern question. Usually with angel syndicates, you get some syndicate fee and sharing a carry with a syndicate lead. What is your approach to this, like attitude? Is it justified, do you think?
From my perspective, yes, because again, the syndicate that I join gives me something unique that I don't have as a solo angel. And I think, most reputable, good syndicates, they have to, make ends meet as well. And they have to deliver, content and deal flow and manage. So that whole process, obviously, that costs money and resources. And I think it's only more than fair enough. And also, by the way, we are completely aligned around success, right? Because when there is a successful exit, only then will they capture some of the upside. So, yeah, I think it's entirely justified. And I don't have any issue with that at all.
Yeah, maybe just on average, like what fees of the angel syndicate do you see on the market?
To be honest, I can't give you a straight answer to that because I haven't compared different angel syndicates. But, I just think follow a reasonable approach to that. Do something that you're comfortable with in terms of the fees that you are paying. Like you said, there will be some upfront cost, and that needs to be reasonable in the scope of, they have to run the syndicate. And then the upside, I don't know, it really depends, but I guess somewhere between 10 to 20% of any upside once there is an exit is reasonable, I think.
Yeah. And about the process of co-investing with the syndicate, is it still manual or is it already quite digitalized?
Again, I'm only a member of one syndicate, so I can only speak of my experience with them. And for that syndicate, it is to a large degree automated. So it's a reasonably large pool of investors on the platform. Everything is through Notion. There are investor videos, there are pitch decks, etc., all found in the same place. And it's a quite quick turnaround in terms of when the founder pitches to when we are to commit our capital. So it has to be pretty automated, and it works really well. So my experience has been very positive.
And actually, like how fast usually you have to make a decision about the investing? Because I'm asking also like from perspective of when you make your own investments. So usually how long it takes, and also if you're investing with a syndicate, and specifically the one that you mentioned. So how fast you have to make a decision?
Yeah, so it's very different. It's a good question. It's very different. When I do my own kind of solo angel investing, and when I do my own due diligence. It typically takes much longer. And often I will either be mentoring or maybe working with the startup. So I will know it or get to know the startup quite well before I end up investing. So that can mean, I don't know, sometimes 3 to 6 months, sometimes even longer. With the syndicate, it's totally different proposition, right? So there we have VCs who are leading the deal. So they have done all the heavy lifting and the due diligence on the proposition. And then I only come in, or angels come in very much at the later stage. So with Ventures Together specifically, you typically have, 4 or 5 days at most to decide. But that's fine, because then you are relying on the VCs having done the due diligence, and then you do an accelerated DD as a solo angel alongside that. Yeah. So I have a kind of barbell approach.
Yeah. So what is your aspiration, and one thing that you would really want to change or contribute to the angel investing ecosystem?
That's a good question. My aspiration is to be as useful and as helpful as I can be to founders. And if I can play a small part in the overall success of a startup, however that success is defined, that's incredibly, gratifying and incredibly satisfying to see. Also, typically what you end up seeing is successful angels typically redeploy their capital once they've had exits. So I guess once you're in it for life. But enjoy the journey. For me, it's all about, if you can help someone build a successful company, or even if it turns out not to be successful, but enjoy the journey. That for me is key, and try and be as helpful as possible. Sometimes I get the sense that the term angel has been forgotten in terms of why are we called angels. It's really important that you stand behind that. You are there to help and support founders in whichever way you can, and that sometimes when things are going well, but often it's also when things are more challenging, and then it's really important that you show, what you can do as an angel investor.
Yeah, thank you, Nic. It was a great pleasure having you here on our podcast. I actually welcome all our listeners to contact you. We had Nic Lenz here with us today. And please subscribe to our next episodes, where we bring you angel investors, venture partners, and inspirational leaders from a venture capital industry. Thanks a lot, and have a great day, everyone.
Absolute pleasure, and thank you very much for inviting me. Bye-bye.